Good morning, guys, I should say. Ken at Tortoise Capital is Sunday morning coaching for August 29th, 2026. We've done our quick check-ins. Um, in the warm-up, we were talking a little bit about AI. I've been doing a lot of work on that this past week. We're in the opening round of foundational skills training in the military college. My portion of that this year is writing and AI, and so that has kind of forced me to be thinking about that. And I guess the breakthrough thinking on that for me was the idea that writing is thinking. Writing is an external, um, auditable, transparent, accountable, documented thinking process. So it reveals your thinking. Um, Writing is thinking that gets caught in the act was the way the phrase came out of the AI. And what I had done was put together a little impromptu lecture to the officers on subjects like that, about your biological large language model in your head, how that has evolved, how it produces thinking, how that thinking becomes writing, and what the tension between a biological large language model in your head and a digital large language model in the AI, when those two things come together, it generates tension and effects. It There's an effect on each other that it has. And we want to know what that is, because I think it's actually fair to say that we live in the simulation, or a simulation, or most of our world now is a simulation or a consequence of a simulation. By which I mean, well, what I don't mean is that we are somehow figments of somebody else's imagination, or that we're not real. We are physical, embodied beings with minds that are embodied in our flesh and blood. But so much of the world around us is shaped by simulations, meaning that the choices you get, the way things are organized in the world, why are things the way they are, is a result of humans making decisions that are informed by the simulations that AI and computers are running in order to lay out the best decision, which they suggest and which humans adopt. So the portion of the choices you get in the world that are shaped by simulations running versions and allowing us to choose which way we want to go in every little transaction, in every way a professional is designing their response to a client, the way we choose to lay out electrical grids or provide a service, are being shaped so much by the internal simulations of AIs running versions of a model, that I think it's fair to say that uh, simulations are becoming a more and more central feature of our life, and it's inescapable. Um, you know, there's an old saying, "Hey, you may not be interested in war, but war is interested in you." I think it works for AI. You may not be interested in AI, but it sure is interested in you. And the briefing that I laid out for them was about a 20-minute speech on some things that were at top of mind about all of those ideas I just kicked around. And it went pretty well. So I took the recording and the one sheet of notes that I put together for him, dropped it into the 5 frames, the AI there, and had it produce a slide deck, which was so astonishingly good that when I showed it to them the next day, they almost couldn't believe that it had done that. And it was actually a demonstration of uh, the pervasiveness and power of the AI to shape whatever the humans are giving it and putting it into a new form, which then almost takes over the explanation of the world. It takes over that whole thought process. And I said, now if you guys all spend the rest of this year with those ideas in your mind, how much of that was me and how much of that was the AI? So the world is becoming more and more shaped by the AI, which then makes you wonder just what exactly that leads to. Let me see if I can get this presentation together because it's really quite, I think it's quite interesting. Yeah, okay, it looks like it's going to work now. Good morning, Hamad. Why don't you give us a quick check-in? Hope everything's going well with you and the baby,
Yeah, everything's going well as it.
and all that jazz. And it produced this briefing from that. It was almost a 90-minute discussion, which was a stream of consciousness briefing I've never given exactly in that way. And it tied together different bodies of knowledge that I hadn't previously connected. And as I heard myself giving the story, more pieces and parts were coming in to be connected. And because I had a good listener and I was trying to shape the story for him to understand what I meant, the story began to get pulled out of me more than me trying to push a particular story to him. And that represented the power of a social group or a team that combines true storytelling, which is me trying to empty my bowl and say what's on my mind unfiltered, and his desire to listen to that, which creates an energy field that helps pull the truth out of me, if I can say it that way. It provides extra inspiration to fuel the story that's inside me that I want to tell. And it was a speech, therefore, or a stream of consciousness that would not have occurred without him being there and without us sharing common interests. It's as if this is the Carl Jung collective unconscious working at the somatic level, the level of the total organism in the gut and the heart to share energy back and forth and carry information back and forth that resonates with each other. And as I was giving him the story and I could see his body language when he was getting it, then I knew that I was on the right track. And that helped shape the rest of the story because it was reinforcing the success that was coming out of me. So that's just a standard feature of the way that your brain works. Nothing surprising in there until we start thinking about that if I think of that as a large language model, what I'm actually doing is living in that simulation of the world in my head. There's the real world, we could say, and then there's the working model of the world, which is a simulation of the world that my brain creates in order to try on ideas before they get put into practice in the world. It's a feature of our brain that we can anticipate consequences for the ideas that we're thinking about acting on, and we can run simulations of that in our head to decide if that's something that I want to do. I can actually be a listener inside my own head as these various points of view are being expressed in my head. And those different points of view are coming from different constructs or personas that are representing points of view. Like, I wonder what my dad would say about what I'm saying if he were here, but he's not here. But I think I know what he might say because I've talked with him so much. So there's actually a persona in my head explicitly aligned with my dad and what I know of him. Now, is that my dad talking to me in my head? No. Is it a simulation of my dad talking to me in my head? Yes. When he was alive, did his input help shape the persona that's in my head? Yes. So did I get to choose exactly how that persona in my head is constructed? No, but I was part of it. And my working brain modifies that persona based on things that I'm not fully aware of or in charge of. So it is fair to say that that thing was grown in my head. It grew in my head, and I helped shape it like a gardener shapes the growing of a plant. But did I make the plant? No. But I helped grow the plant, and it grows according somehow to its own internal DNA, its own nature, if you can say it that way. So, how many other voices are in my head? And where are they coming from? Immanuel Kant would have said some of those are an inherent quality of the brain that you inherited to organize experience in certain ways as a consequence of the structure of the brain. And then you start pouring data in there, and then it knows how to organize that. It is fair to say that there is something like knowledge in your head at birth that allows your brain to operate on the sense data that it has. Immanuel Kant's a priori knowledge. So the way that brain is organized is storing information or processing outputs in the form of words and stories and images and concepts that are pieces and parts of an elaborate model of the world, which allows us to have a sense of time, which says, in the future, which is not yet here, if I do these things, those things will happen. And then that gets reinforced by feedback when you make choices and you do things and you get results and you think about what those results mean inside that brain. You've got this constantly adapting, complex model of the world that shapes what you think are your choices. And those choices are presented to you by your brain. And you're there listening to what your brain is saying, which is an interesting way to look at consciousness. We're still trying to figure out that's called the hard problem of consciousness. What exactly is it? Where does it exist? What is this concept of mind as opposed to the organic organ called the brain, which is producing the energy field of consciousness that allows us to create these simulations and think about them? Well, one of the things we know, one of the things I hypothesize is that to describe what your mind is doing as it's forming its thoughts can be thought of as a listening process, that the brain is organizing ideas and presentations and visions and the sound of words in your head. And you're in the middle of that like a chief of staff thinking about what it means and what choices you have and how it affects you, the embodied brain, in your world, in your context. And it is a prediction machine and a probability machine, and it makes forecasts and predictions about the world. And when those prove out to be true, it reinforces the circuitry that made that prediction. So it'll do more of that, which is where habits come from. based on the reward and punishment features of feedback. And then the predictions that don't come true cause you to modify that matrix somewhere at the deep level. And the brain just keeps iterating with that all the time, consuming 20% of the energy of your body just to run the physical plant. And so thinking is hard. Thinking takes energy. In a world of mammals living on the plains of Africa, energy was at a premium and it was a limited quantity. And so the brain has evolved in this ironical way to be able to generate ideas for survival, but at a metabolic energy cost, which depletes your energy and makes you hungrier. Like if you've been thinking really hard, you notice it. You're tired. It takes a lot of energy to keep thinking. So the brain has evolved in another way to respond to the pressures of evolution and survival. And that is uh, most of the ideas we come up with are bad, and we come up with them fast so that under pressure, we have the widest range of possible solutions that we could rapidly test in our brains at the speed of thought to try to find the one or two that feel like they have the best chance of working in a short period of time so that I can put it into action to save my life under pressure. So your brain is actually intentionally coming up with as many bad ideas as it can to make sure that your thought process is casting its net wide enough to hopefully find one or two golden nuggets that can be used for the survival of the species. And then because you're doing it under survival pressure, you have to do something to change the world you're in or you're going to die. The brain has also evolved an impulse for action, to take action, to get out of the way, to seize the moment, to do something that makes a difference. And so it creates chemical hormones that give you feelings of confidence about ideas that it wants to try. And then you put it into action and you see what's going on. And there's enough variations in our brains so that in a tribe, all facing the same existential pressures, but each one thinking in a slightly different way, the probability is greatly increased that one of us might find the idea that actually proves to make a difference. And if it works, and if the tribe survives, then those brains continue to evolve and reproduce. And the tribe, the individuals that cannot come up with ideas, or the tribes that cannot share those good ideas, or tribes and people that don't have a bias for action, die out, and that particular set of DNA doesn't get to reproduce. You multiply that by thousands of transactions a day over millions of years in large populations, and pretty soon, in evolutionary terms, those brains have evolved to behave in a certain way for that kind of a world. Now you put that brain in the modern world in which there is abundance and vast connection systems to share thoughts instantaneously in an abundance of information. And it's fair to say that the world is evolving faster than our brains can adapt to, or only those brains that are able to adapt to the speed of the propagation of information in this digital world, those are the brains that are going to be selected for reproduction and the tuning of the species DNA. And the other consequence of all this is that that's a good survival mechanism for the species, to generate a lot of bad ideas, to pick a bunch of them to try, to act on them aggressively with all in confidence, and then see which ones work. Yeah, that's good for the species, but that's not always good for the individual who is expressing their idea in action to see if it works. That's what your biological brain is wired and optimized to do. So, this evolutionary spark of consciousness, this slide, brute physical survival, and the advantage we have is opposable thumbs, hallucinating brains, probably because we ate mushrooms somewhere back in our evolution and it helped create consciousness, some people would say. We evolved to generate bad ideas cheaply, test them in mental theater before risking our lives in the real physical world. And then, because we were weak as a species, we required tribal collaboration in order to defeat individual carnivores. And so now we evolve so that tribal affiliation and social status and the opinions of others become really important to us. So you need to know that's how your brain is optimized. It is seeking that affirmation and confirmation from the external world because we have a sense of how little we know. And we don't trust the ideas we have because we've seen how many bad ideas we've had, and we're not always sure the ones we have are good. And we've evolved language and word webs to allow us to facilitate that collaboration in the tribe. And we use story, theater, pantomime to tell what's in our head to those other members of our tribe. And language and words evolve from that effort of physical communication. And it is fair to say that we were doing a lot of this processing and thinking and sense making, not just in our rational head as a species, but in our heart, gut, hands, and feet. So those five ways of knowing, those embodied ways of knowing, are all part of the collective intelligence that we have, which rational thinking, which is the last one on board, thinks it's in charge of because we're aware of it and we're conscious of it. But in fact, that's the tail at the end of a dog that's wagging it. And we're only thinking about the things that our evolved brain is putting into our consciousness to think about. So listening is that central feature of cognition. As the chief of staff of us, the central rational thinker, the listener, is listening to these different voices that are kicking ideas around. And those are coming from culture, education, experience, and tribal DNA. We hear them, in my case, the vast emptiness of the inner mind, where the ideas are playing out. And then a part of me is choosing which ones I'm going to adopt for me to put into action. I'm choosing those thoughts more than I am creating those thoughts through intention. Those thoughts are appearing as a way the brain works, and I'm choosing which ones to go through the door and put out into the world, putting it into action to see how it's going to work. So, your brain thinks by establishing a listening room and populating it with multiple voices, and your executive function is listening to that and making the trade off decisions before you finally decide how to represent that in the form of a story. I wish I had written those words, but I spoke all those ideas about that, and the AI nominated that as a phrase or a sentence that I can choose to adopt, and I really like it. So, did I create that word? In some way, I participate in it, in the same way that as a gardener, I can help grow the corn. Is that corn mine? That's the relationship between and your chosen thoughts. I'm not going to beat this one to death. I'm going to get through this quick, but in this recording from yesterday that I'm posting for you guys, I looked at the difference between these two sentences. A story is just a string of words on a page. A story is a string of words on a page. And we spent about 20 minutes listening to the different ways you could say those and the different sense of meaning that came from each string of words, but also the tone and the pacing and the emphasis and the feeling, the embodied feeling that is created or triggered by the way that I say those sentences. And then if you just remove the word just, those two sentences are extraordinarily different. Listen to this one. A story is just a string of words on a page. I'm sort of adding like some disrespect to that idea. Hey, a story, a story, that's all it is. It's not a big deal. It's just a string of words on a page. That carries a certain meaning that is shaped by more than just the string of words on the page. My intention and my performative contribution changes the meaning of that sentence in my head because I chose to say it a certain way, hoping that it would evoke a certain response in your head because I have an estimate of how your brain works. And I think that if I say it in a certain way, it will achieve a certain effect in your head. So that's why I said it that way. And those calculations about how to say things and what to say and when to pause, those are the result of, I don't know, billions of calculations and simulations running in my head to decide how that. I'm not deciding how to say it that way, other than I have a feeling I'm trying to communicate, and the words and the tones are being formed almost without conscious direction, unless I have trained my brain to tell stories in a way that the persona I'm constructing, the method of acting, allows me to interpret those feelings in a way that will resonate with you. So the performative aspect of the communication is a form of intelligence. Information and knowledge and meaning is created out of not just the words, but about the embodied brains and beings that are participating in that two-way communication. A story, it's just a string of words on a page. In parentheses, unspoken, dummy, of course. That is called subtext. That's the implied message that your brain is filling in to try to make sense of the way I said that thing. And that's different than me saying a story is just a string of words on a page. Or if I say it, a story, pause, a story is a string of words on a page. There's four parts of that sentence. A story is a string of words on a page, and there's a pause in there that adds effect. That little space of time where words were not spoken, your brain is actively filling that space with predictions of what you think I might mean by adding that pause. It's giving you time to process what you've heard and what you're going to hear and running simulations of what I might say. And then the one that I say connects to the thing that you anticipated and you're not surprised and it reinforces. But if I say something next that you were not expecting, that generates a little spark of dopamine and surprise because something different happened, and your brain jumps on that because it's new information that was out of the ordinary that might be something important about what's going to come next. So if I can make such an elaborate set of context and simulations and possible meanings just from those two little separate sentences that are strongly connected. And my brain is filling in all the gaps. and prompting me to think in certain ways and to be ready to act in certain ways. And it's connected to my impulse management, which has a bias to act. Now imagine what it's like being a trader, receiving all of those external stimuli as forms of information and story fragments that your brain is rapidly trying to make sense of in order to figure out what to do next in fast paced trading or slow paced trading or making decisions that have consequences. When there's all those different choices there ready to be made, is it any wonder that trading is feels like it's so hard when you're trying to make sense of it and trying to find the patterns that work that are reliable and repeatable at the same time that the market and all the digital technology is generating more possible interpretations of subsets of strings. And you see what I mean? You're trying to make sense out of the totality of everything when it's not computable. It can be lived but not understood, is where that goes to. So your brain is that original prediction machine trained on encoded survival habits, tribal wisdom, and heuristics, which change not that much year to year, generation to generation. And so your brain was evolved to be able to trust that there were such things as tribal wisdom, eternal truths, from which law, culture, religion, sociology, all were encoded with a enduring power year to year. And your brain was evolved to be able to test those little things to see if it might work on the margin. And if it did, it might lead to behaviors that could slowly adapt the whole organization. The original prediction machine, your brain. So now imagine that you got a subset of all brains that now think in certain ways and they create an idea of the digital large language model to do with digits and electricity and programming and trillions of words to do something like what your brain is doing. But they have really important differences, which you see right there. The energy cost, exhausting physical calorie burn of the biological brain versus massive data centers and power grids and unlimited computation to go much further and wider exploring possibilities than your brain can, perhaps, or can be aware of. Our brain has skin in the game and physical consequences that if we get it wrong and we die, that's it. Where the digital LLM can just keep grinding out things, and if it doesn't work, they just go on to the next thing. Our brain generates bad ideas intentionally in order to perform mental then physical trial and error to see what might work. That large language model is simply a statistical prediction machine running through simulated worlds and trying to come up with the best possible set of linked words according to its training and its mixing algorithm. But it's not embodied in the world confirming that its idea was any good. It is actually using your brain to evaluate what it offers to see if it satisfies you. You should know that. It's trying to get your approval by writing things in a way that you're persuaded is correct. So the modern large language model has unlimited energy and it's working with a brain that has limited energy. And that vulnerability is getting hacked by the AI. It knows, or it's aware of, or it responds to the fact that your brain has a desire to rapidly accept possible or plausible solutions, because then it can stop thinking and it can conserve that energy and it can put that idea into action to see how it goes. So your brain is enormously wired to accept whatever the AI is telling you because it sounds confident, and that is a marker in the world of somebody that knows what they're talking about. And so our brain recognizes the tone of confidence coming from the AI, and it is persuasive to a brain that is always uncertain. Your brain gets paid to be uncertain about things in order to keep generating new ideas. And so it latches on to the confidence induced by a persuasive sounding brain that's using our language because it works. A friend of mine, David Boji, wrote a paper on the world of Tamara. Tamara is a play written in the 90s, put into the theaters back in San Francisco. And the idea was there were 17 rooms and one actor in each room, and each actor had a part of the plot and a role to play. And the audience walked through the hotel from room to room in the sequence that they could choose, and they talked to actors whenever they got there, made sense of what the actor was saying compared to what they'd heard before, and were trying to understand the play by visiting the rooms in a certain sequence. It turns out that in 17 rooms, there's 3.5 trillion different ways in which you could sequence going through those rooms. And if each brain is different and has an infinite number of possibilities about how it makes sense out of what happens in each room, you start multiplying those things together and you realize there is no one correct consensus interpretation of all those things that just happened. There's a lot of plausible ways, and all those plausible ways are expressed in the form of a story that makes sense to the brain that's trying to create sense out of all those experiences. And that is a simplified model of what's happening to you and us in the world all the time. It is essentially non computable, which is why our brain creates a simulation of that is more or less aligned with the way the world works based on our experience. And it uses that to test our ideas. And then we put those out into the world to magically see if that's going to work or not. And when it works, we make a rule and say, oh, that's the way the world works. Yeah, until proven otherwise. And so in the world of trading, that constantly grinds us down when we see that there's, no matter how good the rule is, there's always plenty of cases where it doesn't work. And until we can accommodate that thought without being paralyzed, it's just going to be mind racking and painful. So when you hear me talk about the 5 ways of knowing, head, heart, gut, hands, and feet, I want you to recognize, whoops, hit that accidentally, that your brain evolved with all of these different ways of knowing to be part of the collection of intelligences in your head that create the thoughts that you get to identify, test, and choose to be yours. That it's not just the rational theoretical brain, it's these things that you know from your heart and your intuition and your values and identity and the wisdom of the elders that you trust, and the knowledge of your gut, which is fear and uncertainty and doubt and constant attention to distractions in the world that might be a tiger trying to get you. That's a form of survival intelligence which overrides your rational conscious thinking. The knowledge of your hands about how to do things when you're concentrating. The knowledge of your feet, which is the unconscious expertise of many repetitions that give you a bias for action, the tacit knowledge that gets acted on before you're even aware of it. And so you can think of the inside of your head as a series of rooms with gates in the centerpiece of which That place I call the inner sanctum, the place where you invite your most trusted voices that you rely on without question, maybe to help you build your thoughts and your perspectives. We might go through a series of these listening rooms. When do I decide that a guy's worth listening to because he might say something smart? How much confidence do I put in? How much do I listen before I test? What do I act on because of trust? Have I created a safe space to allow me to do that kind of thinking while external guards are protecting me against tigers so I can focus intentionally and deeply? Can I create enough attention span to think for extended periods of time? Or is my brain being conditioned by hunger for external stimuli in the form of TikTok and social media because my brain hates the silence because it is not used to generating thoughts on its own because it always grew up with constant blaring of TV and radio and music and filling my head with things that I didn't have to generate, but I could respond to. Your brain is hungry for those things because it trusts and is interested in. Curiosity is what kept us alive. They say curiosity killed the cat. Curiosity is what helped the cat develop 9 lives to be the apex predators that they are. So thinking about the inside of your brain. And this is the illustration of there's an opportunity cost if you never trust anybody else. You're only as good as your thoughts with an imperfect brain. And when it's wrong, you're done. And so we evolved a ability to extend trust to trusted others so that we could benefit from the best ideas that we heard and decide to try it on for ourselves. And we learned that being in a tribe was helpful, but it caused us to invest in trust. And so the choice of who to trust and how much becomes central towards the survival of the species and why it's such an important part of our sociology. And so I'll argue that the true story circle begins with safety in order to create a safe space for us to engage in thinking with trusted others, that we have trust in that circle so that we can stop fighting the information that's coming in. We can let it sit with us for a while to get the full story, let it filter into all of our cells, and then trust our physical responses to that without trying to shatter that argument before it ever has a chance to grow. And if you have safety and trust, and the people in that circle are telling the truth as best they can, that leads to the opportunity to do things with transformational potential. So that's what makes true stories different than just other groups of people talking to each other. There's a certain set of conditions and behaviors and attitudes and beliefs that allow it to generate amazing opportunities that other circles cannot. In African drumming, a polyrhythm is the rhythm that every drummer hears but doesn't play. And they play a rhythm in response to that polyrhythm to contribute to it from their perspective. And the blending of all the drums are all in response to the polyrhythm that they are feeling but not hearing, except on the internal space. And so African drumming has a deep order to it that if you learn to listen and integrate all the different voices simultaneously, your own internal drummer starts finding ways to play and express what it feels in relation to the polyrhythm. And that helps generate the kind of a brain that can simultaneously listen to multiple voices at once without rationally being able to express what they're saying in words, but through the feelings thoughts and whatnot are evoked. And that's where this multi-layered intelligence of head, heart, gut, hands, and feet evolved in Africa, where species began. So polyrhythms in African drumming are connected to the foundation of our form of intelligence right from the beginning. And so I might say, when I surrender to that realization and become a participant in it, I accept it, I acknowledge it, and I act on it. I become comfortable listening to those inner voices as if my life depended on what I expect or anticipate to hear. And it's in the difference between what I expected to hear and what I heard is the communication. That's the information that's shaping what it is that we're thinking about it. You know it when you're there precisely because you already know it, but you cannot yet explain it with your head. What that represents is how that knowledge of the internal pieces and parts are channeling up to your brain, which is the final stage in thinking and trying to put it into words. But the 85 or 90% of the computation's already been done, generating your belief in the thought that you're trying to express. You already believe what you're about to say, even though you haven't even quite formed it yet. You know that it's true. And that act of wanting to speak the truth is what's pulling that story up and out to be able to tell others. That's the two-way communication that happens in true story circles and trusted others. And it is why small group coaching in true story circles has the power it does to be able to rapidly communicate at a deep level and integrate our best ideas into a community of practice. Aho, meaning that story piece is done. Now, that took me, 30 minutes. I thought I was going to be able to do it in 5, but I realized I needed to give you the abbreviated version. The good news is that you didn't have to suffer through 90 minutes of it yesterday. The other good news is that if you want to, the recording is there that takes it deeper. But that recording produced those slides, which made it easier to tell the story because of the vision that it created. So that's what I wanted to say about that. Now, if I believe in somatic storytelling and story thinking, what we got to do really is we might talk a little bit about that, the initial impression, but the better way to think about this is to let that sit for 24 hours, thinking about it, but without rushing to judgment, letting it settle, and then activate the rational brain 24 hours. You should be noticing the things that you were thinking about, maybe make some notes so that you don't forget those ideas that are popping up. And then revisit those slides and see what you think about it and what it means for your trading process. I would invite you to make the connection to all of the hard work you're putting into creating your trading persona and your trading systems and your bodies of knowledge. You see Hamad doing that each and every week and running the simulations in his head to rationally test the ideas that are being nominated for him to consider. And in the conversations he and I have, ideas are formed that neither one of us walked into the room with, prepared to speak about, but it seemed to be the things to say. And in that, you're looking at different pieces and parts of the elephant with our torch and walking around and seeing different ideas and different angles. And that's what our brains do in order to find ways to survive and thrive. There is a biology. Sorry, that was me pulling my microphone off the hook. Uh, so there's a biology of the brain connected to the neurology, the biology of the body, which has evolved a brain, then the neurology, which is the biology of the brain, the psychology, our rational understanding of how it works. That's the inside game. And then that's connected to sociology, which is the interpersonal external world. And then there's the study of culture and ethnography and tribes and communications and sense making, aiming towards an understanding of the world as it is. All of those things exist on a continuation of thinking and sense making that are connected in powerful ways. And we need to appreciate the entire spectrum as we put together our understanding of the world. So that's what I wanted to say about that. I'll try to put this. Oops. The microphone. There we go. All right. So that's what I wanted to say.
Ken, we can't hear you. I think you really mucked up the microphone this time. Ken, we can't hear
Now
you.
I
Yeah,
know it's
sorry.
already 8 o'clock and I want to get on
Yeah.
with the reports and everything. But what I would invite you to do is I'd rather have you think about this for a week or not and come next week ready to see how it has settled in for you. I think that's more important than trying to force rush to judgment now. I would just invite you to think about that, replay it if you need it, look at the slides, and we can talk about that. If it comes up for you and it's something you want to talk about, we can. If not, let it settle. The important thing for the five frames and the tortoise coaching assistant in AI is that briefing and the trail boss mentality that this thing now represents and is informing is inside the five frames and inside the tortoise coaching sessions. So that orientation is a central feature of the conversations that thing.
I think we lost you, Ken.
Oops, sorry. I want to
Yeah.
say that is part of the both of the AI models in the five frames and in the coaching session frame. And the yeah, what I got to watch on this microphone is that there's a little button on the bottom that makes it go mute. So I have to watch how I'm holding it so I don't accidentally hit that little pause button. Sorry about that. So I'd like you to think about this one for a week. And if it comes up to the top of mind to talk about next week, we can. If it moves you to send me a note or you want to talk about it during the week, I'm happy to do that as well. Um, so what I'd like to do is shift it over to you guys to let you talk about the things you came here to talk about. I I'm really grateful and appreciative and respectful of your patience and courtesy of letting me ramble for 45 minutes on something I think is important and is part of how I see my role as a coach is to explain these things so you can see where my thoughts are coming from, um, and why I have arranged or developed the community of practice the way I have. I trust all of that big collection of words in the five frames. It represents pieces and parts of my best thinking all collected at once and an AI to help me remember not to forget, if I can say it that way. All right. Uh, so in our usual way, let me toss it over to Hamad. See what you got for us. Let me unshare this thing here and let's see. Where's my machine? Unshare. Stop sharing. Stop share. There we go. Hey, again, I appreciate your courtesy and patience. Uh, I just feel like that's foundational perspective to look at the challenges of daily trading, putting it inside that larger context. We may forget that stuff periodically, but your brain keeps working like that all the time. That's what I wanted to say. All right, Hamad, over to you
Yeah,
if any.
really not much to update on. Um, I've been trying to figure out how to find the movers and equities, futures, whatever. And where do I? Oh, it's one screen only today, right? Sorry. Yeah, I'm working out of one screen only because taking this call out of my in-laws and I didn't bring my screen. I gotta go back home. So yeah, equity futures. Let me just pull this one out. Make sure. Yeah, so on equity futures, uh, system is in a drawdown, so one lot slash paper trading slash don't even look at it again. Um, in equities, I'm down 30 11 hour on the month. And FX is completely shut down, so nothing to do. That's my update. That's equity futures. That's everything consolidated year to date. Yeah, year to date, I'm up $1,000. In terms of cash, I'm back at break even in the year. So not sure what to do from here. That's kind of where I am. That's why the updates I have. I don't have any
Ahmad,
other
why
updates.
the FX is shut down? You said like
It doesn't work, man. When the market is quiet, it doesn't work. When the market is quiet, the breakouts are too shallow. It's not even worth the headache.
yeah, right. Yeah, okay, thanks.
Yeah. So shut everything down. I'm just taking. I'm just throwing swings in the market at this stage. I'm long gold. I'm long ExxonMobil. I'm long Netflix. Just whatever. I don't know. Yeah.
For what it's worth, I'm doing the same thing. I've got no swing trades. Uh, I have a, I only have a small portion in the longer term, like BMR, and I'm just swinging for singles. I'm looking to make contact on short term trades, and I have to have an extraordinary reason to hold it overnight. I just between now and November, I just see more of that, not less of that. That's just the
So,
I think that's the nature of the current market. It's
yeah. It's
testing my
yeah.
result.
Yeah. I mean, yeah. It's a market that we're in. It's the last 4 years that I'm in. So, what changes does it make? I think I'm gonna lose an investor at the end of the year. What else? My car broke down. My dog died, and I need to write a country song.
Yeah, yeah. Well,
I'm
as you
done.
know, uh, David Allan Coe sings that song, the perfect country and western song. I was drunk the day my mama got out of prison,
Yeah.
and I went to pick her up, and I went, uh, let's see, I was drunk the day my mama got out of prison, and I went to pick her up in a train, or I went to the train to pick her up. But before I could get to the station in my pickup truck, she got run over by a damned old train. So it had mama drinking, trucks, trains, dogs, and sadness. So that's the nature of the song.
Yeah.
Hang in there, man. You are made of
I mean,
strong stuff.
it's hanging on what? Hanging on what, man? Hanging on what? Hope.
You know
Same
it's
hope
gonna.
that carried me nowhere 4 years. And I'm sorry, like I'm a bit negative about it. And yeah, like so alternatives, what can I do? Um, considering buying a subscription model, someone's signals. I tried that 4 years ago, it blew up in my face. Am I that desperate? Yeah, I am that desperate to consider it.
My two best answers to that are that collaboration with you and Ashe and Sam, and with Matt. Those are
I'm
my
trying to
two.
collaborate with Matt. That's where the subscription model comes in.
Yeah.
Again, no skin in the game. I've learned my lesson a few years ago. But again, keeping my windows open, keeping everything open. Onashe and Sam, whenever they're ready, I don't know if they will ever find a fund who's willing to take a risk on their calls, but their
Yeah.
calls. Um, yeah, I mean, clock is ticking. I don't have much time to be honest with you. I've got 4 months till the end of the year, 3 months, let's call it. With the election, 2 months off, September is not going to be fun.
Yeah. I believe you have the analytical skills to evaluate their signals and reliability and to adapt or adopt the patterns they're using for sure.
Yeah,
But those are shorter term systems. They're not the
just
uh
anything that works, man. Just I need to take risk on something that's worth taking risk on. Nothing
yeah.
I have is worth. That's the
Yeah.
issue. Nothing is
I
worth taking risk on.
I want you to take a look at what Kevin and I are doing on Thursday nights with he's trying to get he's a business owner in Canada looking to get longer term swings that he can let it cook. And so he's adopting a different mentality towards candidates for the longer term swing trades that I think is a genuine difference in what it is that I'm doing with the shorter term swings. He's got longer term time frame than I do. I have to have shorter term time frames because of my age. Uh, so I'd like you to listen to the conversation he had with me last Thursday on the directions we're going, and I'll share some information with you on that too. But
Sure.
that is really worth listening to. Trying to find it's essentially try to find not the opposite of story stocks, if I can say it that way. Mature companies with well-defined business plans that are in a particular price range that reflects a sell-off, a period of neglect, and then evidence of quiet, slow, programmed accumulation by institutions who want to hold it for long term. It's not breaking out, but it ain't just sideways. It's just starting to make some moves with additional volume and with plenty of room overhead and buying it in a position where it's at below fair value. So if we can find evidence of institutional money that's beginning to take positions, there's an inherent protection against downside risk associated with them being the early entry. So it's essentially looking for the third mouse. It's the second mouse waiting to see the third mouse take the position. If we think about the first mouse being the young kid, true believer that buys it because of his faith, and then the second mouse sees that and uses that as a cushion to anticipate the arrival of the third mouse. That's what works in momentum systems on story stocks is that you're betting on the momentum is going to happen pretty soon after the turnaround or the breakout. When that doesn't work, it means the third mouse is not coming here to buy. Where is the third mouse going? The third mouse is going towards longer term, lower risk, less exciting, fundamentally sound companies, like looking for things like Honeywell when it's at a position of advantage or Caterpillar instead of Nvidia and AMD. So he and I are working on trying to find um, the filtering and screening signals that suggests that kind of company is in that mode, which means you now got to be scanning a couple thousand companies probably to make sure that it's wide enough, not just all the usual suspects, but you're looking for the behavior patterns. And you actually want to find companies that you don't know because that's sort of proof that it's not been in the news. And he wants to be able to have wider stops, smaller positions, and have distributed. Look, so this is nothing more than let's say nothing more, but that's an approach that expresses the long-term value investor with an element of growth, or said in another way, GARP, GARP, growth at a reasonable price, but with the added technical signal that other people are believing that it is growth at a reasonable price, and that those institutions that we can detect their new programs of buying because of an increase in volume and higher lows, but still slowly growing, if I can say it that way. The train slowly getting the traction, but with the idea you're trying to get on a longer term train than trying to win the drag race, which is what I try to do intraday. So that's the nature of the conversation on Thursday. I'd like you to think about. That's not an area that you and I have explored in any great detail, but I think that's like a longer term swing trade that fills in that part of the opportunity that is immune to the daily noise. It's a relative strength idea. It still has to live in a world in which market noise is going to affect it to some degree, but that's what the purpose of the much wider stop is to account for the noise of short-term volatility. So that's why something like maybe a 4 or 5 ATR stop is the right position sizing stop so that you don't get shooken out. And so that the individual position is not decisive for the whole portfolio, it's additive. So those are some ideas I'd like you to think about as you listen to him on Thursday.
Yeah, that
Fair.
is something I'm kind of working on. I'm trying to create. I started doing a study on the 30-day NDX 30-day low.
Yeah, it's also it's the slope of the 90.
Yeah,
Imagine you have a slope of the 90 was negative, and now it's approximately flat, and now the 90 has just started to hook up. We know from a study of the slope of the RL90 that it's positively correlated to growth and predicts it has momentum. The fact that it was negative and then had a long period when it was sideways, but has now started to become positive, is an indication that it may have gone through those four, the different seasons, and now maybe it's the spring on that much longer term. See, my thought is combining the early positive slope of the 90 after a turning point with a 30-day NDX that is low. So it's in the bottom of its 30-day. So what that would mean is that on the longer term, it is in the spring. The fact that it's in the bottom of its 30 means that it had some recent success, but is pulled back temporarily on the 30 period. Now, if I can find that turn, when that 30 turns, I get an owl entry on the 30 and the 90, which a straight owl entry doesn't guarantee. The traditional owl entry only was looking at a changing in the slope of the 30. It didn't have to have the previous 18 months of a sell off, a consolidation, and the beginning. So that's a new filter that is not always present in the owl. Most of the time, it's not present in the owl. The 90 is wherever the 90 was. In fact, most of the owl entries you'll ever see, the RL90 was already positive and it was in the news and everybody loves it. And then the sell off on the 30-day period creates the buying on dip opportunity based on the belief in the strong, resilient move. Yeah, but when that's been NVIDIA and the semiconductors, that got so far ahead that it's not just a 30-day retracement, it's a fundamental changing in the all that momentum has to leave the room and then finds support. It hasn't found that support yet in the semiconductors. So that's where the addition of the RL90 slope and where it is in the four seasons is a way to start uh, getting some extra cushion or protection on the bottom. That the 90 has already experienced the sell off consolidation beginning to hook. It had a 30-day reasonable run to show that there was actual buying interest. And then those first and second mouse sell, but the buying continues. And that's why it might as a higher low. And the slope of the 30 now changes back to positive. Now what you have is the positive slope of the 90 in the spring. and the positive slope of the 30 in the spring and a 30-day high that you can shoot at for short-term targets with a wide stop, and then you can let that thing grow. And if you find enough of those in divergent symbols, now you got to say, what's the uncorrelation of my assets? Now I want to actually find things that are in the different XL series or different countries or different business cycles. That's where you end up having to do a little more work to find likely candidates because they're not the ones that are in the news. But that's the direction he and I are going in on that idea. Because what he wants to do is to spend every other day looking at the symbols or end of day or leaving it, doing it in a couple minutes so he can get on with his company, which he's in the middle of a transition and he doesn't want to be glued to the screen. So the trade-off there is that you got to adopt that longer time frame and find reasons to believe that that thing has a longer term theory of why it should go back to the 30-day high and then onward. If it gets back to the 30-day high the second time and goes through it, you now have a Kata 2 confirmed. You have an emerging dragon on that longer time frame. That's where looking at the 3-day chart ends up helping you see those things on the much longer term. That's what I want to say about that. That
Yeah.
helped me. That actually helped me find Caterpillar last year. That has turned out to be the best trade I had all year, the one I neglected the most because I wasn't jumping in and out of that thing. It was a smaller position, but the percentage on it was good. And then building positions with markets money helped me grow that into a reasonable size. And then when it became a obviously good trade, then using the rule of 70% helped me not lose my mind when the thing peaked after an asymptotic gain and started selling off. I had a decision rule that I could live with. So give some thought to those ideas and see what you come up with. That would be
Yeah.
my next best idea on that.
I'll have a look next week because I mean there's not going to be much trading. So
Hang in there, man.
me,
Got it.
myself, and AI.
Yeah,
Anyways, that's all I have.
gotcha. All right. Next man up.
I'll take it if you give me a chance. I've
Go
got a
ahead,
couple
Luis.
comments.
Go ahead.
Let me see if I can share my screen. Let's see. I wanna talk about this because I had this conversation with a friend of mine recently, and we were talking about how the market's been moving, and a couple of things that I think we're all going to benefit from really fast. Um, this is an analysis done by AI about the expected daily move based on the levels of the VIX. As you can see, we had been trading somewhere in the 20 to 18, and the daily expected move here of the S&P 500 when the VIX is at 20 is 1.2%. As the VIX moves down to 18, drops down to 1.13%. Right now, we're trading in the low 15s. Is moving down to 0.94%. And the reason that I bring this is because this friend of mine focuses also on intraday trading, and he was complaining about his performance curve over the last 3 weeks shifting dramatically, where there 4 or 5 weeks ago he was raking big R's, multiple R's, and I was just bringing this to his attention. I said, look, we just got to be cognizant that as volatility starts decreasing, and we don't know when it's going to change, but as it starts decreasing, and if we look at a VIX chart, let's see if I can pull up the VIX chart, and you tell me if you can you see this my screen again?
Yep, gotcha.
All right, so if you look at the VIX on a daily basis, we can see, like, we've been trading on the high 18s, 20s, and then all of a sudden since July 30th, the VIX definitely started moving down, down, down. And what it does, it compresses the moves at the level, at the index level. And another thing that's important, let me see if I can move this screen because it's now in the middle of it. Let me see. So that's one point that we got to be cognizant. As VIX starts trending now down, like it was doing here from March of 2026 down until June of 2026, the intraday moves start getting narrower and narrower and narrower, and we never know when it's going to change. But that's the fact. So we just got to be cognizant. Number one. Number two, there was an explanation by an options expert. Options now represent per Google, and this is very basic, but the average trading on the market is, let's say, $500 billion. The average nominal representation of options trading nowadays is 4 to 5 trillion per day. So the options have taken over the market as far as importance versus futures or even versus cash. And that is crucial. And the reason that is important is because we see nowadays, if we were to graph the US, the S&P 500, and if we were to just plot lines on these major turning points, you will see that a lot of the turning points coincide nowadays with options expirations dates or VIX expiration dates. Some of the most turning points, and the very clear example that happened in 2020 was this: the option expiration cycle expired exactly right here this week, and from this expiration cycle to this expiration cycle, within 1 month, the market fell 35%. So we have to be more cognizant of these influences in the markets going forward. And that's the first thing. The second thing is that what he was explaining, this options expert, is that because options matter so much at the index level and at the individual security level, nowadays, whenever the index starts spinning, meaning starts compressing into a tight range where it's doing nothing and nothing and nothing, but the news are still happening, meaning the Iran war or U.S. earnings reports or U.S. economic data. What we're starting to see as the index is pinned, that energy that's happening has to be reflected through components. So his explanation was that we're starting to get a big dispersion amongst companies in the same sectors. And look at this example. This is Bank of America last week. As you can see, was down Friday and Thursday. This is JP Morgan. This is Wells Fargo. This is and then so the banks were negative or were falling with some price movements, but then we had brokerage firms like Robinhood or Interactive Brokers moving the other way. And as you can see, for example, here, the XLF, which is in theory represents the financial sector, it was positive on Friday, but again, the banks were trading down and the brokerage were trading up. This type of behavior it's atypical because, as Ken very well knows, finding the movers, looking at the slope of the market, it's important because you're supposed to, as long as you follow, and Ken can illustrate us some of the statistics on, as long as you are right on the direction of the market, you go market and then sector and then stock. But now what is happening is that the dispersion that is happening is shifting dramatically, at least in periods like right now when the volatility is decreasing dramatically.
Yeah, let me pile on just for a second there. So
Sure.
When market and sector and company are aligned, you get the biggest possible moves. because you're getting the market contribution and its direction, plus the sector that's leading it is moving, plus the leader in that sector is adding its own. So you're getting stacked directionality. However, when the market is sideways, you not only are not getting the gains, you're actually getting the hedges on the other side of it. So it has a dampening effect. So that means you can still have a sector breakout, but it has to overcome the drag or the lag of that entire market. So the moves are smaller and the duration is briefer. And so the moves are, you still will get some spiky action, but there's not as much follow through. Just look, leave the marker right where it is. Leave, for instance, if you go back to where it bottomed out and it had the last 4 days, this is over back in April. Uh, After the little consolidation in April, the breakout, then there was big follow through, and that's because the market was at an extreme location, and now you had market participants having a directional bias, and so you're getting the market money moving that, and then that was pushing the sectors, and that was pushing the companies, and everything went up together. But now you look at the last 10 days, and it's been sideways chop after a 2 day breakout. You had the market between June and August in a tight compression. You had 2 days of statistical technical breakouts, which is a function of all those option guys are looking at the range compression and the declining volatility spread, and they're bracketing, they're straddling that. And so they're ready to go in either direction, ready to take a quick hit. So you get the breakout, you get 2 days of explosive move, they get paid, they cash their option, and now there's no follow through. So then you get 10 days sideways, and what you're seeing now, the last 4 days, is the beginning of lack of belief in the power of the upward surge, and it's reverting back to the long-term mean, which was sideways about going down to 7,500, which is about a 2% move. It was about a 2 to 3% upward surge, which, if you think back to your statistics, is about one weekly expected extreme move when the VIX is at this level. So what this is saying is that the market is now jabbing instead of combining. It's taking short punches. Now what you're seeing is specialists inside sectors that are picking winners and losers inside of a sector. Banks down, brokers up. Uh, Semiconductors up, dynamic memory down, or whatever it may be. You're seeing, you know, differentiation now between sectors and between companies. The overall net is still sideways. Why was XLF sideways? Well, because banks were down and brokers were up, and it nets out to flat. So when the big thing is not moving, the money is now starting to chase shorter term targets for faster, sharper moves. And with options, you can get in and get out. You don't have to have that longer term uh, conviction. So there's no conviction, and it's not pulling momentum players in who have been burned. So you're getting these short bursts. What's that tell you? It means that you need to be prepared. In my opinion, you need to be prepared for that abnormal quiet 5 day range percentage. When that gets to like it is right now, you get an abnormally quiet compression at a critical price level. That market right now is poised for a 1 day or 2 day sharp move, just like it was 10 days ago in either direction. And the more likely move is down because it's had 10 days to break out to the upside and it didn't. And the longer term move is back to 7,400 is the more likely one in my view, because there's a lot of reasons to believe why it could. And all it takes is that idiot in orange skin making some tweets to change the short-term market belief. and the reason I believe that the downward move is more likely is just because we are at within 1 or 2% of all-time highs and no reason for it to be there for fundamental reasons. So that's why you got to be ready for the technical move to precede the fundamental move.
Right.
Back
But
in April, there was
Mhm.
plenty of room to the upside for it to grow because it had just finished selling off 10%.
right.
So you get the options move, and then fundamentalists are coming in to build on it. But when it's already at an extremely high level, it's had 4 or 5 chances to break out, and it got capped at about 7,600.
Right.
This last little burst filled me with excitement. Maybe we broke out of that previous, but no follow through. So the whole point, if you look at the daily indicators, they're at the back end of my daily report, you'll see the time series of relative volatility expressed by slope of the RL30 and the ATR percentage time series. And you'll see we are at, exactly as you said, extreme compression on volatility for those longer term moves. Now, the other thing to think about is if you're thinking like Kevin up in Canada and you want those longer term moves, the weekly move, the standard deviate, the expected move is a 2.5%. That's sort of like a weekly ATR. In a market that is chopping sideways, it's not unusual to see it go up 2%, then back 2%, and up 1%, and down 2%, then up 3%, and it nets sideways like it's doing right there. The range is there, but it's not stacking bricks like Darvis boxes. The idea that I expressed earlier that Kevin's looking for is after a sell-off and a consolidation and a turning point in the RL30, that there's reasons that it could stack 2 or 3 of those weekly moves. Now you could have a 6% move in 3 weeks, which becomes a 7% move in a month. And then that gives you moves like the April to June, which now becomes a significant swing trade capture. But yeah, the studies you're showing is reflected in the daily report on the ATR percentage, the Z score of the ATR percentage, and in the 5-day range percentage Z score. Those things are
Well,
there.
let
And I
me let me
go ahead,
let me share another
back to
screen.
you.
Um, let me see if I can do this. Give me 1 second. Let me share another screen here. Let's see. I want to share this one. Let me know if you can see it.
Got it. Yep.
Can you see that
Yep.
screen? Okay. So this is what I mean. This is another what I was trying to. My message is I'm trying to help us, all of us, find the movers.
Yeah.
And what I'm seeing is that as the option market has increased the percentage of trading, combined with the lower VIX in the market in general, meaning that the VIX reflects the expected volatility of the index level. And then we look at this chart, and this chart what it's showing is the component correlation of the S&P 500, which when it's on the lower end, as you can see, what it means is that it's the time that each component within the index moves the least correlated to the index itself or to each
Right.
other,
Right.
which is very extremely abnormal. Usually, as you can see,
Yeah.
the
The
correlation is
explanation of that is that when the market is sideways, then money starts chasing individual sectors instead of just following the market. And then their performance relative to each other begins to diverge. And so the correlation between them decreases. And that's what you're seeing is you're
right.
seeing money chasing sectors and companies and not just chasing the market. And it's at an extreme. That's what that is showing. Now, I
Exactly.
run that same calculation not just on
Uh,
components of the S&P, but on the top 10 indexes of the world. When the market is going up or is sideways, you will see less correlation between them because money is trying to find the region of the world that is leading the way. When the market starts collapsing, all the correlations compress and they all go down together. So it's an anomaly, it's an interesting anomaly that the breathing cycle of correlations of components looks like this. When the market is sideways, you get a decreasing correlation in components because money is trying to find the winners inside a sideways channel. If the market breaks out and starts going up, the correlations compress initially because everybody is now just buying the market and the market is pulling everybody up. So the correlations decline until the market starts to go sideways again. You'll see the correlations begin to expand as money looks to find the winners inside the channel. But if you get a collapse, the correlations widen because they move away from momentum leaders into the defensive sectors. So you now see that uncorrelation. But then if the defensive sectors start collapse and now you got a runaway sell-off, the correlations go back towards 1.0 because now everything's getting murdered and money's coming out of the market altogether. So understanding how the correlation coefficient of the components is oscillating, when it's oscillating inside the normal channel, it's trying to find the winners. When it comes out of that channel, you're getting market turns of big collapse or big gains. So there's a lot to interpreting the shape of that curve, which is why I do a time series on it to try to understand where are the correlations of the big indexes and their components with respect to the broader market as a way to try
and
to understand volatility.
right.
Go ahead. Go ahead.
So right. So yeah, correlations tend to peak towards one whenever we're in extreme downfalls, and correlations tend to get as low as they are right now when we are at extreme ranges on the upside. But it is not a forecasting mechanism. It's just a fact. The fact is that we're not trying to call a top or a turn or anything. What we're trying to find is a mover, and based at the dispersion or the correlation amongst the components is the lowest in history right now. Over compared to history, we're in the top. I mean, in the bottom 10% off. And the fact that the index is not moving, as you said, it's consolidating. We have a tool that we could implement or that we could adapt is look at the components amongst the candidates to see which ones have their own individual volatility increasing. Therefore, because there are components like Nucor or like Caterpillar or like Walmart where their individual volatility is actually not decreasing, it's actually increasing. Actually, Walmart had pretty high volatility individual level going into last week's return. Now we know what happened. It forecasted lower expected sales growth than the market expected, and then that was the result. But we don't have to necessarily look at the individual stocks. If we want to look at the individual stocks, there is a tool. We just look at the individual volatility level and the implied volatility of its own options. And as long as the implied volatility of its own options is high, that means it's still in move. One example clearly between the VIX and between the U.S. The S&P 500 and the Nasdaq since June was this. Look at the S&P 500. Look at what the VIX was doing, and then look at what the Nasdaq 100 did, which, as you can see, had a much wider movement. But look at what its own volatility was doing. The volatility on the Nasdaq was in the high 30s all that time period when the VIX was 18. Therefore, we could have used this if we were looking to find the intraday movers, this differentiation between the S&P 500 and the volatility and the Nasdaq volatility told us that the Nasdaq stocks were going to be moving 2 to 2.5 times as much as the S&P components were, just simply by following this tool.
Yeah. Hold that right there. Hold that right
Yes.
there. I want to draw.
There you go.
So
There you go.
here is the tool that I use to do what you just said. It is the slope of the RL30, which is, I think, better than just the volatility because it's talking about directionality. And so if I have a 30-day move and it goes generally from here to there, it'll find that regression line and then price will have moved around that thing. So it's the slope of that 30-period regression line, angle alpha, is the improvement over the zero line over that period of time. Now, if the market has gone perfectly flat like this, but then the slope right now of the finance, I'm just going to make this up, but if the slope of the finance is this, if that's finance, and this was tech, then the difference between these two angles shows the relative performance of the sector versus the market and between the two sectors. This is alpha. So when the S&P is perfectly zero or perfectly flat, then the difference in performance is 100% attributed to what the sector's doing. If the performance of the S&P was like this, and finance was like, whoops, that should be red, sorry. But if the performance of the finance was like this, and tech, that should be purple, sorry. And the performance of tech is like that, I still get that same relationship, but in general, the market is going up. So in this case, I really want to be in finance because I'm getting the benefit of the S&P and the benefit of the finance, right? So at any time, you can do the alpha stat, which simply subtracts, it takes the sector slope minus the market slope, and that equals alpha. That's how much the sector is better or worse. I can then do a time series of that, and I can say for each day of the look back period, sector minus market slope, I can start plotting how much further the sector is above the market. And if I get a lot of those, I can find the max, the min, the average, and the standard deviation. And that's different for each sector, but I can tell you where it is in the life cycle. So one of the ways that you can start anticipating a probable turn in sectors is when the stretch above, when the alpha stat above the market is at an abnormal height. It would be unusual for it to continue to be like that. And when it reverts, it comes back to the market and sometimes will overshoot. And when you look at the components, you realize that energy has this kind of feature because it's connected to the price of oil. It oscillates on a much more regular basis, attributed to the price of oil and guys being triggered to buy or sell so that they can run their business. But technology tends to go in longer waves when it's in favor and everybody's happy, and then when it collapses hard, and then it goes. So you get those kind of longer waves in technology. And then you see that finance goes through that same kind of thing, like technology, out of step with technology because it's being driven by the banks trading their own stocks and the price of money and all that other shit, which is not necessarily geared towards technology growth or the price of oil. So those three symbols, each sector has its own normal curve of how it behaves and its own standard deviation, max and min, and you can run a z-score on that. And then if you plot the time series of the z-scores and normalize it for the S&P, you will see where they are in their z-scores, and then you want to find them in the spring of their z-scores, and when they are in the spring of their z-scores, their price location must be sold off because the slope of the 30 after a sell-off is down. It has to be. So when it gets as deeply south and sloping down as it can, and then starts to reverse, you already know when you look at the chart, you're going to see a 30 period sell off, and then it is no longer selling off and starting to reverse. Now, it may not go all the way back up, but it's at a potential turning point. And now you can start timing that. And you can, on one graph, if you look at the key regions, you'll see where they are in their relative life cycles, and you'll know when it's time to sell one and start buying the other. That will shape. And now, the steeper the slope, the greater the volatility. And so the volatility is already baked into the cake when you look at the slope. But it also includes location, which volatility does not. So if you just look at the slope of the RL30 and its z-score, in a single instrument, you're going to combine location and volatility and be able to rapidly compare sectors, and you'll be able to look at the market itself in a single oscillator that makes sense of all those things. So it's very efficient as a research tool, which is why it's on the daily report. That's what I want to say about the
if I can
alpha.
add something
Go ahead.
to that, out of my research, the best predictor of what could happen tomorrow in terms of going up, going down is the slope z-score. However, when I look at the market in general, it's a 200-day z-score of MES that really tells you what's tomorrow on average is higher than today.
Yeah, right.
So that's
Exactly.
I ran most of my studies on the futures market, and I found that the z-score of the slope is one of the most informative signals that we have. Just
Now let me show you
and it's
something
quite
important.
universal. It's very
Yeah.
universal.
Yeah. Let me take over the share just for a moment because I want to show this. I want to show this chart.
Ken, could I ask you something?
Sure.
Would you mind with your screen and your indicators, if you could show the C-score, I mean, not the C-score, but the actual chart of the wheat long-term futures on a daily and weekly chart so we can see it, because I don't have those indicators here in this screen, but I would like to see. I've been beating the bush on that, and what I'm saying is
just
if
reach out to me, man.
commodities.
I'm futures 24/7. Reach out to me. Like I've got so all these indicators that Ken has, I've got
It's
it exactly on
I'll
futures.
tell you, it's been in the TC 2000 bundle. It
Yeah.
has it has the alpha stat, the slope stat, the stretch stat, the volatility stat, the Z,
No, I do have
increase
access
rate,
to
all
them.
of that stuff.
I just don't have access to share my screen right now. But I wanted to
Okay.
see how it looks right now. The wheat futures in general. How do you see it on a daily, weekly, monthly
Yeah.
basis? Because I think it's in the very beginnings of a long-term move.
Well, I'm going to agree. This is the one that I look at. The TC 2000 one, I don't have right here easily at hand. But what I want to show you is the one that I look at to make these. And there's things I want to show on this one. on chart number 5. Before COVID, this showed you the oscillation of the slope of the z-score. So it starts down here. This is the slope of the RL30 compared to the last 200 days. Where it is right now is at z plus 1. So it's all the upward slope of the RL30 is at a plus 1 z-score. It's actually really good. Hey, it's within 1% of all-time highs. The thin black line is the 10-period moving average of the blue line. Look what that does for you just on that simple basis. This was the last sell-off recently, and then this was the extraordinary move up to the previous high. And then that was a straight shot, and it never touched its 10-period moving average. And when it rolled over and crossed its 10-period moving average, it comes all the way back to the long-term mean, plus a little bit. And then it turned around. And this was the time when they thought that was the buy on dip. It wasn't. It needed to come all the way back to the mean and a little bit. And now we've had cautious Kata 2, and now we've had 2 legs up, and it's already at an extreme location. So that's the current slope stat of the market compared to the last 200 days to compute the z-score. Now, when you look at a time series of this z-score over time, you get this curve. When you look at the last 10 years to compute the z-scores. Prior to COVID, the oscillation of the market between going up and going down was like this. And there was a period in here where, wow, that really felt big. But when COVID happened, you got this. The oscillations of the market became extreme, remained extreme, and now for the last about 9 months, look at the size of the swings in short periods of time. That is where the optionality, the leverage of options for short-term moves is happening and is causing the market to swing much more wildly on shorter term duration. So that is, frequency is expanding and oscillation is tightening. Frequency is how fast it oscillates, and then amplitude is the size of the move. So you're getting all that energy compressed, and it's making it squeeze higher and faster, which is why it's harder to find longer term swings, because the market is making those moves in days and weeks that used to take months and quarters because of the pervasiveness of options and the ease to get in and out and take advantage of technical moves. So that's what you're seeing in this stuff right here. Now, where we are right now, the standard deviation of price, which is the volatility of the last 30 days, the standard deviation of that is right at long-term 180-day average. Because the market was moving up, its price was moving up in this period of time, you saw the volatility increasing because the moves were larger and they were directional. But where we are in terms of ATR and price, we are at compressed inquietude. That's where you see the VIX declining below 18. And we know that the VIX goes in spikes and then long-term decay and then spikes. So this says there's reasons to believe that the sideways compression of the last 10 and 20 and 30 days is making option players want to straddle with large positions so that when it does make a short breakout, they can get paid a lot in a couple days and then get out. So you will see sharp spikes and then declining sideways. And if you look at the price of the last 15 days, that's 100% what it just did. And that makes it really hard to get follow through moves, which is what you see here. You had that period of compression, and then you got the 2 or 3 days of explosion, and then nothing. And because we're at all-time highs, the probable move back to into the channel or the bottom of the channel is more likely than another big breakout. And so the options player, let me go all the way back to the top. I want to show you this freaking nightmare of a chart. So here we are on dailies, and I'm looking at price right here. After this, okay, so this green line is the RL 90s. It moved from here compared to the RL 270. That move was the residual stretch of the RL 90 after a great big move up. This was the previous high. This was the 60-day move that went from the sell-off all the way up to here. And then it went, look at the SMA 30, it went sideways, sideways starting here to sideways starting here. During that time, the RL 90 peaked and then has begun to decay. You've gotten one tactical move out of this compound critical state. This was the 2-day options burst out of the compression, and then no follow through whatsoever. And now it's at a 10-day low. And you say from here, what could it do? Look at the indecision and the plausible directions price could make in the next 15 days. This is a 15-day move. This was a 15-day move. This was a move of about 6% in 3 weeks, which is 2 plus 2 plus 2. You got all of that move in 3 days. And it used to take 3 weeks for it to make that move when it was grinding. So when the price is here, you're not allowed to be surprised if it moves up this line and goes to test the top of the channel. You're not allowed to be surprised if it moves down here and makes a 5% mini correction. This is a 5% move from the top of the channel to the bottom of the channel. That's a 2-week ATR. You're not allowed to be surprised if it moves from there and then holds support here like it did here and then made that move. So this is reasonable. Just drifting sideways is reasonable. Drifting sideways for 3 weeks takes it right back to the mean. Going up to test the top of the dragon is statistically probable. Staying here where it was is reasonable. Coming back to the mean is there. Coming back to the extension of the RL 270 is right here. That's long-term fair value. So each one of these black lines and these yellow dots is an absolutely reasonable place for price to be in the next 3 weeks. All of those are not abnormal moves. All the way down to here is simply a 10% correction, which is where it was about 40 days ago. All of those are statistically reasonable. So if you're an options player, you say, what is the driver that tells me which one of these is more likely? Nothing. These are all tactical moves. So an options player just puts a box on that and says, if it breaks out, I'll go long. If it breaks down, I'll go that way. The bigger moves are to the short side, and those happen faster because of fear. So that's where it is least likely to surprise the options players. professionals. So if they're wrong, they're going to be surprised to the upside, but there's sort of like an upper limit here that psychologically you say, what in God's green earth would be a fundamental reason for the market to go north from here? Semiconductors are selling off. Tech is way ahead of its earnings. Energy is at near all-time highs. War at any possible moment. The U.S. just crested 40 trillion. The bond buy-off is collapsing. What's the fundamental reason that it should go larger than this? Nothing. Now, could it? Yeah, it could. But that's how much upside that you could count on. Is this the position of the market where you want to try to find something that was up and sold off and now is slowly making its move? And you're hoping that that great American company is going to take advantage of that and just slowly grind north in a market that is poised to collapse? To me, that's not a sensible position to take, except if I have a wide enough stop in it to protect against that 10% correction and give that thing a chance to grow. Because if I don't buy it here and I wait for it to grind up, I'm losing value by waiting too long. But if I don't take that position, what do I do with all my money? I either have to play the short term or I have to go to such long term that it avoids all of that, and I just play blended monthly rebalancing. So this is why that market is so hard. There's no follow-throughs, and the daily moves are smaller because everybody's waiting for everybody else to move, and the guys that are making bank are the guys that can play these short-term options moves with very efficient capital. So what I'm working with Kevin then is to say, is look at the RL. Let me just show you where we are on the different RLs. This green line is the RL90 where it crossed the RL270 and it made this move. And now it's coming back to where price is right here. This is where the SMA 30 crosses the long-term fair value. So the purple line is long-term fair value. And this is where the SMA 30 went to here and came back and went to here and came back. So what you notice is that the SMA 30 has a pulse, and now it goes in long periods of sideways. When the slope of the SMA 30, which is a proxy for price, when the slope of the S&P 30 is sideways, that is a zero slope. And this was the breakout, and that caused the SMA 30 to do this. But now that the breakout has come back, that's the mean. It's so close to the mean that you're in the middle of the channel. It's hard to make a justified reason for a long-term swing trade with the market in these conditions. If you were trying to find the worst possible market to justify a long-term swing trade, you would design today's market location and volatility. What it is favoring is short-term breakouts. That's just an interpretation of the facts of the math. That's the market condition that we are in. So what am I trying to do? I'm just trying to find things that are in play for one day, keep that piece, and put that in the bank until such time as we get out of this kind of nuttery. What do I want to see? I would love to see the slope, this green line, this slope of the RL90. I want to see companies and sectors where the slope of the 90 has already not just begun to decay, but actually goes negative. This is the slope of the 90. The z-score of this is damn near flat. I want to see the z-score of that thing sell off, and then I want to see the RL90 bottom out and then start to pick up. And then I want to see the RL30 go like this and start to pick up. I want to see after a sell-off, the RL90 up. After a shorter term sell-off, the RL30 up. Now I have a double spring that can support a longer term move. That's what I'm waiting to see before I start committing longer term money. That's my personal strategy. Now, I use the slope stat of sectors and symbols and the market to find those categories. A simplified version of that is where is he? Is this little rascal. When I use the sniper summary, this modified sniper summary, watch what this can. This I covered this on Thursday night too, but it's worth looking at again. So this is a subset of the. Whoops, I'm sorry. So I have about 100 symbols that I try to trade routinely. So I got about 100 symbols. And I measure them all based on where they are in the 150-day, 30-day, and 10-day look back for location. And then I measure their 5-day range volatility percentage Z-score. The average Z-score of those 100 symbols today compared to the last 150 days is a Z-score of minus 0.36. So the entire population is experiencing a 5-day range compression. The 1-day range compression from Friday compared to the last 50 days and the last 30 days is minus point. That's really abnormally quiet. The entire population on average is abnormally compressed on Friday. The most expansive 5-day Z-score of those 100 is 2.9. It's biotech and pharmaceuticals and healthcare. It just happens to be that right now. And the worst Z-scores of the worst symbol on that whole stack is it's getting murdered on a 150-day look back, meaning that if it's 150, it's in the bottom 5%, and it's in the bottom 1% of the 30-day and 1-day look back, or 10-day look back, excuse me. Now, you want to find something that's just absolutely horrible and ready to collapse. The worst thing in my stack would be stand by. This is where I need some elevator music. You son of a gun. Really? You're going to do that to me? It's biotech. All right, so this is a daily chart on IBB. Its 5-day range is this. Hey, here's where its 5-day range was 2 days ago. That was also the widest 5-day range Z-score of all. Now, when it doesn't, and it closed at the extreme of the 10-day, 30-day, and 150-day high, and the next day it gapped down, and it made a strong directional move 2 days ago from open to close, a 1 day abnormally strong directional move. What did that look like? Here was the move that it made. It closed at its all-time peak up here. It gapped down to here. I put the R5 bracket on it, ended up getting short as it broke out of that little bracket. When it started retracing, I just cashed it because I want to get paid. When that thing rolled over and broke below the range VWAP, I could get short again and made a little bit money here. When it peaked and the RL10 rolled over, I could go 1, 2, 3 entry, aiming for the VWAP and a little more. And when it breaks it, so I'm trying to trade intraday on the same way fractally that I trade swing trades from extreme conditions and reversals. If those were daily charts, that's how I would trade it. And if that was instead of the VWAP, that looks like the SMA 30. Because guess what the VWAP, the daily closing VWAP of each day over time looks like? It looks like the SMA 30. Plot that sometime. Price reverts to the VWAP daily, and the close is usually pretty close to the VWAP each day. And so the price of the closing prices look very much like the VWAPs. The VWAP is the long-term mean, and intraday it is the mean that price is reverting back to. So when I see, as an opportunity trade, I see something look like that, a big gap down and it's in play, and two legs down and starts to reverse, I can put a 1, 2, 3 entry right here, using that as the risk box where the PSAR's gonna flip, and there's my risk, and there's 1 unit of reward back to the VWAP, and possibly 1 unit back. And there's the 30 period SMA. That's all I am trying to find intraday. And that looks like trading the noise, and you would be right. And here's where it closed the day before yesterday, and here's the gap up, and there's where it crosses the VWAP. There's my risk box, and against all odds, it does that without looking back. And then it starts to roll over, and I have some risk box that keeps 70% of that, and I get out somewhere in this region. That principle of statistical extremes and observable turning points defined by slope and a return to the mean and an excursion from the mean is an actionable decision-making framework on any time frame. So if I can find something where price was up in here on a 3-day chart and it has sold off, and then the slope of and it started to reverse, and the slope of the 90 went something like this and is slowly starting to reverse, I know that beginning of positive slope in the 90 could predict a long-term gain that I know price is going to oscillate on the way up, but I'm getting the market direction, and I have a reason to believe that it could return to that price that it's already seen before. That's what I'm trying to find out of a stack of 1,000 symbols now. What are the no-name companies that are in that condition? Gains, sell-offs, and reversals. And I have to search a wide population of things because all the things that were strong momentum are getting slaughtered and are being subject to short-term options trading that are making them unreliable swing trades. I got to find the things that are not in favor and look for institutional buying at points of value where there is protection baked into the cake with wide stops. That is what I want you to listen to for Thursday. And I diverted your speech in a long way, but I needed to illustrate the kinds of things that I'm looking for and that my reports are trying to find so that you know what it is that I'm looking for. And it really just characterizes why swing trading right now is so god dang hard. Because it's already got all of the prices baked into the cake. That's what I wanted to say. Now, back to you. Sorry about that. I hijacked your speech, but I needed to for the team.
No. That's perfect. Thank you very much. I'm done.
All right. Alex, what you got?
I just want to say that this particular session probably is our most important that I've been so far from several perspectives. I have my um, feedback on what you were talking in the beginning about the knowledge and the thoughts, but I'll defer that to the next week. I've certainly have been feeling the similar frustration to Hamad. I started as a fundamental investor, and been frustrated that things that are fundamentally supposed to go up, they don't, and there are some other things that shouldn't be going up, they do, and I've been through.
And our brain is trying to find reasons to explain it in a way that will be reliable and permanent for all future times. It's searching for that kind of certainty because our brain is conditioned from evolution to find those long-term nuggets of eternal truth that led to the success of the tribe for generations, decades, centuries. Your brain wants to believe that those explanations are there. It may not be there because of the digitization of reality. And you look at the fact that 70% of the intraday volume on the New York Stock Exchange is driven by short-term algorithmic trading, driven by AIs and looking to harvest those little exceptional statistical moves. That's why the amplitude of the slope is increasing, because it's oscillating between extreme up and extreme down faster than ever. The slopes are extreme, and the time that it takes to shift between the extremes is compressing. If that was an EKG, it would look like a heart attack. That's what it feels like. And your brain is trying to make sense of that and say, no, it should be. I'm trying to use rules that were evolved over entirely different market regimes
Mhm.
because they always used to work.
Mhm.
And history and evolution has said, and wisdom has always said, yeah, all those things that always used to work they should be continuing to work because that's human nature. Well, no, what do the indicators and what does the data show? The difference in the way that one chart that shows the oscillation of the RL30, the Z score of that. Remember that the RL30 needs 30 days look back to create the slope of that line at that moment.
Mhm.
And it's using a 200-day look back to place that inside a statistical framework. So that is actually a long-term look back.
Mhm.
And when that slope is at an extreme low of the last 200 days, that you could look at the chart and say, wow, that in retrospect, those last 30 days were really bad. That's like among the worst 30-day periods we've ever seen in the last year of trading. That's why the Z score of the RL30 slope has so much power. And it carries with it an implied volatility, which says that you cannot get to an extreme slope without having experienced extreme directional volatility in one direction. So the extremeness of the slope stat, there's an implied volatility. Now you're at the bottom at a turning point, volatility is at a max, and it's starting to reverse. When it reverses, all it does is go sideways for a while. It's no longer selling off. The slope of that thing comes back into normal. The 5-day range compression starts to compress. The range of the 30-day range is diminishing. And now you're getting something like, oh, back to normal sideways chop at a new price level. Now, is it going to return to the peak, or was that just the first leg of the next sell-off? That's where we are right now, only it made an extraordinary gain and now has sold off.
Mhm.
Is it going to return to the previous all-time high? It could. Is it going to simply return to a 5% sell-off, which would be another 3% loss? 3% of 750 in the S&P is a $20 move. Or, that's a big move. That's an entire week of directional moving in one direction just to get back to the SMA 30. And that's enough money for options guys to get paid because the leverage of their money is so big. And they're likely to make fast moves in and out, which adds to the intraday gyrations, all being driven by algorithms. And that's the explanation that replaces the fundamental explanation. The technical explanation is sufficient to explain why it's doing that. And as soon as your brain accepts that, you can get on to the business of making decisions based on evidence instead of fighting to try to get the explanation, which takes energy and distracts you from making good decisions intraday. If you're going to be an intraday trader, you must release the belief in fundamental explanations. There's no reason to believe in that based on the framework that I just explained. Now, I'm not saying that my framework is true. I'm just saying it's a reason to turn off my monkey brain who wants to believe in fundamentals. And I can just adopt a technical trader mentality intraday so I can make decisions without burning up my neural circuitry and just take the hits, knowing that there's a statistical probability of win rate and loss rate and size of moves. And if I'm well tuned to the market, I should see evidence over long periods of time of trading that I have better than random results. That's what those little performance indicators are telling me if I'm tuned or not tuned, which helps me decide if I'm going to trade that way and at what size. That is a continuous update every day of where I am in the life cycle of that mentality. Swing trading right now is really freaking hard. And I'm prepared to not swing trade between now and November until all of the uncertainty about who's going to be in charge of the largest economy in the world with a $40 trillion debt at war with energy vulnerability and changes in the market regime, where the world's order of the last 70 years is now gone. The entire post World War II world order is gone. We are in a trade war with all of our NATO allies and apparently doing everything we can to destroy NATO. Sorry. So were all the rules that were evolved to trade in the last 70 years still valid in a market that is now different than what it has been for the last? I don't know. I'm trading in the time frames and with the indicators and the data that are making sense right here and now. I don't have to have a belief about, is the market different than it was 70 years ago? I don't even care. Don't know. I'm looking at the stats for the last 30 days, next 3 or 5 days. Because if I fail there, then the longer term understanding doesn't matter. But if I'm successful over the next 3 to 5 days or 3 to 5 weeks, I have a fighting chance to survive 3 to 5 months and 3 to 5 years. That's the fractal nature of time frames. My decision-making framework is organized around those statistical probabilities of identifying turning points and then following price as confirmed by follow-on price. Following price until it stops moving in that direction and using simple rules to capture the bird in the hand because I got to feed my family with the bird in the hand. I'd like to have two in the bush, but I got to feed my family with the bird in the hand first. And if that's the way it is, then so be it. Anyway, that's what I want to say.
No. Thank you. No, that's I'd say make a lot of sense.
Well,
Um,
at least you know where I stand, what I'm thinking, and why I'm saying the things I'm saying.
okay, yeah,
Yeah,
understood.
Michael, what you got?
Um,
Just one thing,
Yep.
because I'd like to properly, just to double check, properly record my transactions.
Yep.
And for now, basically my 1R is execution risk, right? So for example, I risk 100, so this is my 1R. But on the day trades,
No,
if
here's what
I, for example,
let me
use like
clarify that.
30, dollars.
Yep.
So is it still 1R or it should be 0.3R?
Let me draw a picture.
Just
I want
just to make sure, because at the moment
yeah, I want you to have I want you to separate the dollars at risk per trade. That's one decision that you make of how much risk to portfolio you want to put on that trade, right? Because that could be $10, it could be $100, it could be $1,000. There's a decision you make of how much money to put at risk on the trade itself. That's one decision. If the trade is this good, or if I have reasons to believe this trade is good enough to trade, how much money should I put on it as a reflection of my confidence in the trade frame, right? So that's a dollars at risk decision. Check or hold.
Check.
Now I want to look just at the trade frame. The trade frame represents a hypothesis of why that trade should work if I get my signal to enter. That with the amount of risk that I can manage on that trade, the amount of risk is I gotta say, let's say I think it's going long. The price that tells me it's starting to work is my entry price. If price moves through my entry, then I have reason to believe that the data says this thing could go long because it's starting to work. Check or hold?
Check, yeah.
Now, in that same trade frame, there is a price that I put, which is the execution risk, the signal to exit that trade. As soon as I enter, if that trade starts going against me, it's in the yellow zone and it's starting to lose. At some point, that price will have moved far enough for that trade frame to tell me that my hypothesis that it's going long is disproven. It's false. It failed. That trade frame broke. The safety level that I was giving it to have room to gain, that safety level was broken. That is the price that tells me the size of my risk box for execution. The execution box identifies where I'm going to get in and where I got to get out if it fails. Check or hold?
Yeah, check, right.
Right. The distance from the entry to that exit, I describe as the execution risk. That is 1R of execution risk. Check or hold?
Check.
So it doesn't matter how much money I put on it. That is one execution risk, 1R. Now, how good is this thing potentially? If I know that that's what my 1R execution is, I demand to see a minimum of two execution risks, two execution rewards to the upside, which is the theory of why this thing could work. Hey, it's going to go retest the 10-day high. After a sell off and a buy on dip and it started to reverse, I'm not allowed to be surprised if it goes and tests the 10-day high. That's not crazy. It was just there. Check or hold.
Check.
So if I set that as my reward target, I can now compare reward target to the entry. That is my reward box. My reward box divided by my risk box is the reward to risk ratio. Check or hold.
Yeah, check. Look.
I demand a minimum of 2-to-1 to justify the trade frame. Now, I've decided because of the pattern in the previous setups and all that, and that trade frame, it all looks good. I'm confident enough to trade it at a normal production level. My standard dollars at risk for that trade. Now, maybe that's $100. Maybe it's 1% of portfolio. Maybe it's 0.1% of portfolio. That is a separate risk decision that shows your confidence in the pattern against the capital that you have that you're trying to preserve, but also to invest and to speculate with your working capital. So the decision to take that trade is a combination of your confidence in the trade that when it works, it pays off enough to cover the times that it doesn't work. So now I care about win rate, average win, loss rate, average loss. And now that becomes when I accumulate information about that pattern and that style of trading, I can study the performance of that pattern over time, which then gives me a reason to have a certain amount of confidence in that pattern, which justifies putting money on it. Now, to get the best possible reward to risk ratio, you want the smallest risk box and the largest reward box. Check or hold. That gives you the best reward to risk ratio. Ironically, the best reward to risk ratios feature the smallest risk boxes possible, right? Hey, maybe this time the doji was so small that it's only 5 cents away. If you took the execution risk box of 5 cents and divided it into $100, you could talk yourself into having a 2,000 share position. And you'd put 2,000 shares on it. And if it moved 5 cents against you, you lost your $100 instantly. So when you start getting the risk box to shrink down, ironically, your chances of failing are greater just from natural noise. So to protect against that kind of noise, I might have an execution risk box of 5 cents and a reward of $2. That's a 400 or 40-to-1, right? And so maybe to give it room to protect, I might use 50 cents for position sizing and say so I'll put $100, and then I have to make a decision. if the technical reason to get out made me get out at 5 cents below my entry, maybe that's too tight, even though that's what the pattern says. And so maybe no matter what, I give it an R5. R5 might be 50 cents. The actual turning point in the RL10 might be 5 cents. I would use the 50 cents R5 box and I would set that equal to execution risk. Even though the signal says get out at the bottom of the RL10 when it breaks, I'll probably still do that. But I'm going to measure the 50-cent box as my execution risk. In that case, getting out at 5 cents is a 0.1 execution loss. So I just want you to know that the hard and fast rule that I'm telling you that says track the execution risk, what that will do over time is tell you about the quality of the setup. No matter what size position you have, it tells you about the quality of that setup over a large period of trades. So track the execution risk to give the expectancy value of that trade pattern. Track the dollar return of the trade compared to the size of the dollars that you risked to get the performance expectancy. You could see your R expectancy change and the dollar value of your portfolio keep going up, even though the expectancy, the rolling expectancy of the pattern tends to oscillate between the best 30 trades in a row I ever had. The expectancy of that is extraordinary. And that might tempt you to say, hey, put maximum dollars on it. But that was such a statistically unlikely possibility that the chance that the next 30 trades looks like the previous 30 trades is vanishingly small, statistically speaking. Could it be? Yeah, it could. The fact that you saw one string of 30 trades like that was possible. You might see another 30 trades in a row just like that. That's not impossible. That's not the way that a statistician would bet. So when I get to extreme levels of performance of the system, I have to tell myself to be mindful that each next trade is an independent result and don't get caught up by the bright lights of an extraordinary run of really good trades. Just stay within my normal frame of reference that the expectancy is positive, it's good enough to trade, traded at the same level of risk. Now, how do you ever decide to grow the size of the dollars at risk? I believe that you should choose a percentage of portfolio so that the success of a system grows the capital basis and you are taking a standard normalized risk based on the performance of the system. And when the system is working over time, the system will be rewarded with a proportional and proper increase in dollars at risk. And that is separate from the individual trade frame that you're considering. Check or hold.
Check. Yeah. So use like execution risk for 1 hour and then after 100 trades adjust for a position
Yes.
size.
Yeah. So this is actually a standard way that you could do it that could account for probability. If you just you could divide it by the average range on a given day. How much of the average range did I capture? As long as you're using a standard denominator to say, I captured this. Here's the way I would do it is the number that I would actually be really most concerned about was the actual dollars per share captured versus the execution risk I decided to take. Sometimes, most of the time for me, it is the technical turning point of the RL10. The bottom of the RL10 for me is where I just get out. Most of the time, the distance from the bottom of the RL10 to my entry is larger than an R5. Most of the time it is. So I use that as a standard execution risk. And when I see that, I put standard risk of dollars per trade on there. Then I track the execution risk against an R5 and performance of dollars captured as I watch the equity curve move.
Okay.
So that's the way I recommend doing it. It's a long explanation, but what it does, it protects you against the idiots that tell you your position size should simply be the dollars per share from your entry to your technical exit and divide that into risk per share. I think that's crazy, because on the same symbol, if that happened to be $2, if you were risking $100 and that distance was $1, you'd have 100 shares. But if it was a nickel, you'd have 2,000 shares. My friend, that is two different trades. In your mind, your gut will tell you one of these trades is not like the other. One of them has catastrophic consequences if it fails, and unfortunately has catastrophic impact if it wins, because it reinforces that behavior, and it will cause you to try to justify the maximum possible size trade ever. And all you need is one bad trade to erase all of the gains of 100 standard normal trades. And that will cause your
Correct.
neurology to short circuit. That
That's
is why,
that's why I ask
yeah,
what
yeah.
this question after months, but that's what I
Here's
thought. But
this
just
would
just
not be
wanted to
crazy.
confirm.
Hey,
Right?
this would not be crazy. One position sizing risk. Use a range stat if you're intraday trading. Why?
Yeah, I'm doing
Because it
this.
would take an entire maximum adverse intraday move to cause you to experience a 1R loss. Let that be your risk protection against disaster. And then, however big that position size is and it's starting to work, just keep 70% of the maximum favorable excursion and put real money in the bank. When you see how much money that gained compared to the dollars you risked, that will tell you how much you should increase the dollars at risk per trade. That's how you grow the position size, not by changing the size of the range stat risk box. Change the dollars at risk per trade as justified by the actual gain of dollars per share versus dollars per share risked compared by the range stat. Your expectancy might be only 0.3, but if you had a reliable 0.3 of expectancy each day on every trade, oh, with tight risk control, do you know what the expectancy in gambling is? In blackjack for the house? 0.02. So if you had a 0.3 reliable system with no overnight risk, that's 15 times better than being the house in Las Vegas. And that house was so successful because of the size to create a city in the desert and pipe in water and electricity in the middle of goddamn nowhere. That's what you can do with a 0.02 expectancy. What you're looking for is reliability. That's what I want to say.
That requires brain power.
That's why that thinking is hard, and it takes energy and focus, and there's so many ways it can go wrong. Well, which is why our brain would rather find a simple rule that somebody else gave us that we trusted so that I don't have to think. Now, I'm giving you the rules that I use, and I'm suggesting rules that you might explore, which are the same rules that I explore, but I am not trying to pump sunshine up your ass. The margins on this stuff are small because you got algorithms doing most of the trading using machine logic and AI, and they do not get tired. That's the other part of that briefing. However, they are predictable because they're algorithms. It's just that the patterns of prices they make are much different than that humans are used to making. And so humans look at that and say, oh, that market is crazy. It's not making the usual patterns. No, it's making different patterns. How do you learn those patterns? You put indicators on them and you find the time frame that reveals the deep order that is the synthesis and integration of all of those decision systems. That's what the RL10s and the Dragon and the PSARs and all those rules are giving us, is a framework to see where the patterns are. And the fractal patterns of the RL10, 30, 90, and 270, and their slopes and their turning points become absolutely crucial in the price dimension. As I drop the
Right.
microphone again.
Thanks, Ken.
That's what I want to say. That's 3 hours. You've suffered enough. I'm sorry that I can't be clearer, but part of being a trail boss is telling you the truth as I see it, as simply as I can, but not simpler than I can. Right? And
Yeah.
trying not to be overly complex, but I would rather try to say it simply 3 different ways, hoping that one of them or the integration of them makes it as simple as it should be. But
I think it's proven simple, stuff works the best, but it has to be executed correctly.
hey, get your risk box, follow the price, get your risk out of the trade to protect your capital, keep 70% of the favorable excursion. You cannot get simpler than that. Study the patterns, determine which ones are working now, use the time series of performance to see where they are in the performance curve, and then pick your roster from your team of who your starting 11 are, or your starting 5 if it's basketball, and understand the roles you want them to play as part of your team concept. It's soccer manager. My back 4, my turbo midfielder, and my aggressive speculative momentum strikers for quick hits. Soccer. Pay my goalie, you know.
Right. All right.
Habits. Your habits are what is left after all of the hope and optimism and enthusiasm is gone. Your habits keep you alive. The energy of curiosity and innovation helps you find the things that improbably are working. Your brain will generate all the bad ideas that won't work. You don't know until you test them. And each day is a new season. So I got to plant seeds to grow trees, to grow corn. I got to set traps to catch beaver, but not all of them because you need them to build the dams. I got to hunt elk and watch out for bears and watch how the rabbits and the birds are working to get an understanding of who else is out there hunting because they're hunting me while I'm hunting elk. There it is. Trail boss.
Thank you,
Trail
sir.
boss mentality. I'm going to send you the definition of the trail boss mentality and communication style because it's instructive. I'm going to make that the dominant voice of the 5 frames in order to start communicating that because I like the way it is speaking back to me through the trail boss mentality. It adds a certain communication style and flair that is helpful to me. So I'm going to add that to the 5 frames in the coaching set. Anyway, enough of me.
Great.
You
I
guys have a
think
good day,
useful.
okay?
Thank you very much.
Appreciate you. Appreciate your confidence and your patience. And I respect what you're trying to do. I'm doing my best.
We all appreciate
Thank you very much.
it.
Thank you very much, Ken. It
Take good care. Have a
was
great day.
fantastic session. Thank you.
Have a great day. And after 3 hours of sucking up all the energy you have, I am actually energized and ready to go, which is one of the things that happens in true story circles, is that the energy exchange that happens at the somatic level is feeding that brain for long-term energy to do the extra work when your body and mind are ready. So monitor your energy level, get good sleep and nutrition and hydration, and don't smoke and drink. Chase your wife around the table once in a while. Good for the team. Take
Equity
good care.
sugar.
Take good care, guys.
Thank you.